After an unexpectedly high inflation report, market expectations have shifted toward a more conservative approach from the Federal Reserve at its September meeting. Initially, there were hopes for a 50 basis point cut, but by Wednesday, the likelihood of such a reduction had dropped to just 13%, compared to 44% the week before. A smaller 25 basis point cut now seems the most likely outcome, as a more aggressive reduction could signal panic and destabilize financial markets. The recent Consumer Price Index (CPI) report showed core inflation, excluding food and energy, rose by 0.3% in August, slightly higher than the anticipated 0.2%. This reinforces the likelihood of a smaller cut, as persistent inflation pressures make a cautious approach more prudent. Analysts warn that a 50 basis point cut would create unnecessary volatility and suggest the Fed prefers a steady course. Analysts emphasize that without severe recessionary signals or a financial crisis, a 25 basis point cut is more appropriate. While the labor market is showing signs of slowing, it hasn't weakened enough to warrant a larger cut. Historical precedents show that larger initial cuts have often preceded recessions, adding further reason for caution. Meanwhile, markets are pricing in about 100 basis points worth of cuts from the Federal Reserve by year-end. Yet, if growth continues to outpace expectations, this could be reduced, allowing room for stocks to rally as corporate earnings improve. Analysts offered additional insights into how investors can prepare for the upcoming rate cuts. They suggest that the bond rally may be nearing its end and advises investors to shift from bonds to stocks, particularly into the S&P 500. While they are neutral on the Russell 2000 but see opportunities in sectors like energy and communication services. They predict the S&P could approach 6,000 by the end of next year, encouraging investors to take advantage of any market pullbacks to increase equity holdings. In summary, with inflation and labor market data driving expectations, experts predict the Fed will likely opt for a cautious 25 basis point cut. Investors are encouraged to adjust their portfolios accordingly, moving away from bonds and seeking opportunities in equities, particularly in large-cap sectors.